Yeah. Let's bring in Charles Schwab, Chief Global Investment Strategist, Jeff Kleintop. All right, Jeff, it's your job to tell us what to do on a crazy day like this morning. Are you suggesting that anybody buy into this big sell-off?
Look, I think you had to be prepared ahead of this sell-off. Remember, it's tempting to look at this correction we've seen so far, the big peak to trough decline. It's tempting to even call it over at this point, but we're referring to this as volatility, a new era of ups and downs in the markets. Today, you've got an up day. You may see some more down days. This is the type of volatility we've all been expecting associated with the coming Fed rate hikes. All right, so you're telling me that this is the new normal? That's a tough pill for the average investor to swallow. It is, and I hope it's one that they're this is why we have an asset allocation and why we diversify. It's for periods like this. For the last several years, a diversification, asset allocation hasn't really demonstrated its value to individual investors. Now it is. You know, bonds have held up in your portfolio. Small caps have done a little bit better than large caps yesterday. This type of an environment means diversification is paying off, and that's more of, I think, what we're going to expect to see as we near these Fed rate hikes.
I don't know. I mean, the institutional investor might be able to weather this storm. But I mean, for the everyday person who's trying to save for their retirement, who wants to be in this U.S. stock market, for them to listen to this is the new norm, Charlie. That's a rough day.
I hate to break it to them. They should have listened to us more. I mean, you know, one of the fascinating things about this discussion we're having is, and the gentleman just brought it up, and we've been talking about this forever. Jamie Dimon, maybe a year and a half ago, at least a year ago, was talking about how crazy the market. I'm paraphrasing, but this is essentially what he said, the CEO of J.P. Morgan Chase, how crazy the market's going to be when they start to tighten.
Yeah.
And, you know, that's what you see. Now, and by the way, this stuff never happens in a vacuum. You know, while the U.S. is raising interest rates, something somewhere else in the world is happening. And, you know, we just picked a time when something really crazy is happening in the world, an implosion in the Chinese stock market, and not an implosion, but a sort of recalibration of their growth rate of their economy, which is significantly less than we initially thought. So we're raising rates into that. The question is, do you raise rates into that? Do you wait? I would say they should raise rates now, only because I don't know what a year is going to be. And we should point out, economic cycles run 7 years. You know, you don't want to be raising rates in a true downturn, downturn in the U.S. economy.
And if they don't raise rates, what kind of message does that send about their confidence in economic growth? It could send an even bigger warning sign about the U.S.
And what powder do they? What ammo do they have?
We're already discounting what they've done anyway, right? If they had a window to raise interest rates, they've missed it, obviously.
Well, no, I don't think so.
I disagree with that, because you look what China did. You know, they let their market drop 16%, and then they came in and they cut interest rates today. I don't think the Fed is going to let
cut since last year, right?
I don't think the Fed's going to let 2 trading days on Wall Street dictate their policy. We're no longer in an economy that needs zero interest rates.
Do you think this is 2 days? You think that all of a sudden the markets are going to normalize tomorrow?
Well, they're normalizing today. You know, I don't know about tomorrow, but I can say that after a bad week in the market where we entered correction territory down 11%,
I think it's
now
less,
the markets are stabilizing.
I think it's less the markets than does the Fed really think that the global economic growth rates are coming down, you know, dramatically enough that they can say we can't raise rates right now. I think they have to do it anyway, because if this is the future, if this pretends that a year from now we're going to have not 2% growth but 1% growth or less growth, you need some ammo. You need to have you need to be able to cut 25 basis
points. Global economic growth just isn't stalling here. Remember, the OECD leading indicators are actually rising for Europe, for Japan. We just saw last Friday the Purchasing Managers Index for Germany. That was up. The IFO this morning up for Germany. We've seen a lot of good, healthy leading indicators actually stabilizing or even moving higher. For many of the world's major regions, I don't think we're falling off a cliff. I don't think, and Charlie, I guess I agree with you, I don't think the Fed needs to hold back here because of global economic weakness. I think they can move ahead with rate hikes later this year, but investors need to brace themselves for above average volatility, average being the volatility of the last several years, which has been abnormally low.
If we get the market reaction that we saw yesterday in the past couple of days in anticipation of the Fed raising interest rates, what's going to happen to the U.S. stock market when they actually do raise interest rates for the first time?
Well, it's interesting. I guess we could look back to the taper tantrum to see something similar to this hike hysteria. Around that, in the months leading up to that end of QE, we saw a lot of ups and downs in the markets, enhanced volatility. But once the Fed finally ended it, the volatility subsided again.
Right.
It could be
after
move, the first
Jeff,
or second rate hike.
The most unnerving move was in the 10-year, though. The 10-year, the yield got to 3%, didn't it, after the taper tantrum? At the end of the year?
It did. We saw dramatic moves in the fixed income markets, which then eventually normalized themselves. That could be the same thing this time, but you'd have to get back the first, second, or third, maybe even rate hike in order to see that normalization.
Jeff, do we close? Do these gains hold? It's one thing if they hold for the open of trading at 9:30 Eastern this morning, but do they hold? Do we finish higher on the day?
No one knows. I think this is part of higher volatility, and again, one of the great reasons why individual investors need asset allocation.
Charlie Gasparino knows.
I think Dick Grasso knows. The
Ooh,
New York
we'll
City
ask
mayor
him.
in waiting.
Ooh, okay, good
I would say this, and I would ask Jeff this. Suppose all this massive intervention from global central banks doesn't work according to plan. Mm-hmm. Aren't you isn't that a real worry? I mean, Martin Feldstein brought that up in his column today. Mm-hmm. I mean, it seems, when was the last time all this massive intervention really worked? Does it work on a regular basis?
Actually, now that you say that, I'm gonna challenge Charles Payne to come on this program this week, and I'm gonna debate him because I got so many tweets yesterday and the past couple of days about you've been challenging. I have been for a long time challenging Charles Payne on this because he's been saying you're a disservice to the average investor.
You're a disservice?
If you scare them. No, anybody who challenges the notion that the Federal Reserve has been actually helping the economy and helping the markets, why would you want to buy or own a U.S. equity when you know that the Fed's unprecedented involvement has been artificially propping it up? And he says it's a disservice to talk like that because everybody missed this bull market. Everybody missed the rally because they were scared.
He's right, and I mean, listen. When you don't have active fiscal policy, namely from the Obama administration, something that works, the Fed's the only game in town.